Crowdfunding Reggae Plus panel here at Digital Hollywood, and if you've heard about all the other forms of crowdfunding, now we're going to address the crowdfunding directly to your consumers that are buying your products. They don't have to be accredited in any way. They could just be interested in the product and trying to promote the mission maybe or vision behind that product. So all of our panelists are involved significantly with this new form of funding, which has only been around this year, and so it's quite new. I'm going to start with John Streisauer, who's the founder and CEO of GoChip, who has gone through the SEC regulation process on this. So John, you want to tell them a little bit about you and the company?
Yeah, sure. So I'm a serial entrepreneur. I've raised money in a few different ventures prior to this. Actually, for the venture I'm currently doing, which is GoChip, we have a mobile media for mobile devices, so entertainment content on a small piece of media called GoChip that is basically what's going to come after Blu-ray. And because it's a consumer product, it makes sense for us to sell shares to the consumer that's buying our product at the same time. So we've been for some time looking at how can we take advantage of general solicitation, and that's what got us interested in moving into the reggae.
It's a good tie-in if you have a consumer offering. And then David Dobkin is looking at it from the later stage investment opportunities and secondary market.
Hello, I'm David Dobkin. I'm with ASMX Capital. We are operating the first secondary market for Regulation A securities. That's the SEC nomenclature for what we're talking about here today. We offer services all the way through the spectrum, so from the stage of wanting to test the waters and figuring out if this is the right method for you to raise capital. We have a syndication network where we do bring you across a broker-dealer network, and then we help you raise that money. So like we offer a very similar to like a mini IPO or IPO light capability. And then when you've sold these securities, we offer you that secondary platform that operates similar to an eBay system. So it's a managed auction process, which is slower than, say, trading on the NYSE, but these are earlier stage companies, so they don't need hundreds of thousands of shareholders trading in, all over the course of a day. So I'm happy to talk to anybody about that specifically, and let's go on.
And Melinda Moore, who is former Chief Marketing Officer of Crowdfunder, but has been pretty much involved with all of the major players in Reg D, Reg A space in one way or another. So.
Great. Hi, I'm Melinda, and congratulations for coming out on the last day of Digital Hollywood. It's nice to see you. So in my previous position at Crowdfunder, we've raised over $100 million in about 18 months, primarily through accredited investors, raising money for Yao Ming Family Wines, for Neil Young's Pono, Laird Hamilton's water sports company. And as the industry's evolved, I'm now at Next Generation Crowdfunding, which is a company that's completely focused on Reg A Plus deals. And we'll talk a little bit more about that through the panel.
And then Connie Harrell has been the founder and managing director, kind of VP of the LA and Southern California region for Karyatsu Forum for almost 15 years, maybe, yeah. And she runs the largest angel network here in Southern California, and Karyatsu itself is in 39 regions globally, so it's the largest angel network on the planet, right?
Right. We have I'd like to thank everyone for being here too. Welcome to our panel. We have over 2,000 accredited investor members throughout 39 chapters. Our latest chapters, we just opened up India. We have 3 chapters in India. We have a lot of investment dollars coming into companies here in the United States from our India chapter, as well as Turkey, Istanbul, and then some of the other chapters that we have internationally. It's very exciting to be on this panel with John and Mariana. John actually participated in our forum last month, and it's really enlightened me a lot and a lot of our investors in what Reg A is all about. And I think it's going to entice some of our investors to become more invest more in companies because of the steps that John had to go through to get his approval into Reg A. accomplishes so much in the form of the due diligence process that our investors go through, which is a very difficult process.
So it almost kind of brings some regulatory stamp of approval to a seed angel rounds where there wasn't one before. So
Right.
maybe I'll ask, I'll start with John maybe explaining like some of the thinking that went into filing for the Reg A Plus, and then maybe some of the hurdles, and then we can talk about how that affected the markets.
Okay. Well, so the basic thought that went into it, as I mentioned earlier, is that we have a consumer product, and because of that, we have to have a conversation with the consumer. And because we knew the laws were changing, it would allow us to sell shares to the consumer. It seemed very obvious and cool to me to, hey, you know, when you're buying our product and you've got it in the shopping cart, to be able to offer them to put another, you know, 5 shares of stock in that same basket and buy it with a credit card. That seemed like a really cool thing to be able to do. That's what the promise of the Jobs Act really was. And, you know, I think that when you're trying to get money from angel investors and from VCs, they rightly, and I'm an angel investor myself, so I get this, you know, they rightly want to know, are the dogs going to eat the dog food? And in order to find that out, you can spend money on marketing surveys and ask consumers, are you going to buy my product? But that still doesn't tell you anything. What tells you something is when the consumer is buying your product. So if you have the consumer that's not only buying your product, but they're going on to be a brand ambassador, and they're going to buy your shares too, and then they're going to promote it to their friends and family, you've got something that you know is going to be successful. So in a way, it's kind of a self-fulfilling prophecy. And that's what we felt. We have to go out and talk to the consumer anyway. Why not sell them our shares? And that's what led to the decision.
And also, because it's a mobile ecosystem, it's kind of unique and changes, and brings a lot of utility to the consumer to be able to watch a full-length movie without any challenges on a portable platform like your iPhone or your iPad, or at home on your television or on your computer, and have this sort of portability maybe in your automobile, et cetera. It became like almost like we're providing this utility to consumers they really, really need, and who is the most vested party in this thing bringing it to life? It's not really the media companies, it's not really the providers of the current medium to deliver media, it's the consumers, because it's a utility to them, and this would be sort of a proof of concept for them. So whenever you have, I think, a product like this, or maybe one that's about changing the world for better, so it has somewhat of a positive mission in life, like we had a media panel last night of conscious media, those kinds of products do move the needle for consumers, and therefore there's an opportunity for consumers to invest in what they believe in. How is this going to change the investment markets, David?
Well, what we're really talking about here with the Jobs Act and regulatory A plus securities is taking us back to the late 70s and early 80s of stock market capability. So back in the day, you could have bought shares in Apple when it was a very early stage company on the public markets. You could also do that with Intel. Today, can anybody buy shares in Uber? Probably not. Can somebody buy shares in the next great startup? Yes, now because of Reg A. So that's what we're doing here, is we're reintroducing this capability. It's a lighter version of raising capital in the public markets. You will eventually have the capability of participating just as you would going through your Charles Schwab account or anything else like that to buy into these securities. We're building the platforms right now. It's the early stages. The rules just got put in place and effective as of June 19th of this year. So that's why John's here. He's one of the first companies that has gone through the gauntlet of regulatory process.
Number one.
Number one.
Yeah. And this is where we're going, is giving this capability back to the public. And it is a regulatory managed process where you do have attorneys, you do have accountants, and everyone is looking at these companies beforehand. So it's an exciting time for capital formation, and hopefully we're going to start seeing a lot more companies get funded and a lot more investment opportunities.
So Melinda, I have so many questions for you, but I'm going to start here because I've known you for so many years, and you've been head of marketing of major broadband video companies, and then head of marketing for crowdfunding space. How is marketing as a function changing when John can offer GoChip product and GoChip shares on the same page to the same people?
Right. That's a great question. So the thing that's very interesting about equity crowdfunding is the ability to do public solicitation. So now I can publicly go out through the press, through my own digital marketing efforts, through social media, and truly do an integrated marketing campaign to raise money. And what I say is, just in general in the crowdfunding space, so across donations, rewards, and now equity, there are millions and millions of campaigns that are being run. So it's like the number of water molecules in the ocean are as many campaigns that they're out there. So it's critically important to do something that's truly unique, that grabs people's attention and is an integrated campaign in order to successfully raise money. It's not just enough to put your deal, your Reg A Plus deal on Start Engine or Crowdfunder or any platform. Prior to going onto any platform, you have to be very strategic, thoughtful, and put together a fully integrated cross-platform campaign in order to have a successful raise. So the benefit of that, though, this will be my last thought on this subject, the benefit of that is that if you have anything that is a consumer product like GoChip, as you're raising money and building the funds to grow your company, you're also building brand awareness and selling your product. So it's actually a twofer if you do it correctly.
And also, I mean, it kind of justifies some of the budgets that we couldn't justify ever before for marketing to consumers. Because let's think about it. The unicorns pretty much all market to the consumers. They're really not marketing B2B software as a service as their primary source of revenue. They got consumers to fall in love with their product. So that's like that's the holy grail, right, of trying to launch one of these companies. And now you can justify going after that.
Absolutely. So I raised about $3 million earlier this year with Yao Ming Family Wines. Many people in the United States, it's the largest, he distributes more Napa Valley wine to China than any other wine company, but people don't know that. And so when we launched the campaign and raised the $3 million, his wine sales in the United States greatly went up.
And so it's interesting because it kind of markets the product while you're raising the money. So Connie, you run this really well-branded angel network in several territories that are very important. So like outside of Silicon Valley, I would say it's New York and Southern California. And maybe Southern California is more important because you got San Diego, you have LA, you have Orange County, all bedrocks of technology. How is this going to change your business, and where do you see that it's actually making it better?
Well, it's changing the business. For one, that Melinda mentioned is proof of concept. Once a company has gone through a crowdfunding site, especially if it's reward-based crowdfunding, then there's proof of concept that consumers will buy it, they will acquire the product, and then another thing that it's really helped, it creates a lot of exposure for these companies, and then we're also bringing in a lot of angel investors that had not invested in private equity, that maybe they get on a crowdfunding site and then they want to learn more, they want to participate, they want to become a part of a community, and so we're getting a lot of that as well, and we see the investors are becoming more aggressive because there's a lot more opportunity for these companies to get fully funded. So if they're really interested in these companies, they know they need to jump on and make those investments quicker than in the past.
And so that's really interesting because it's kind of like the whole unicorn dilemma, right, John? It's like once you have a unicorn, everybody's interested in it, it's great, but how to get there? And tell us a little bit about the path, the Reg D path, and then why you said, okay, I'm going to try the Reg A.
Oh, well, that's really simple. The Reg D path is the path where you're selling your stock to accredited investors, and there's no general solicitation, meaning you can't advertise it, you can't put it on TV or a billboard or a newspaper. So you're very limited in what you can do in terms of getting in contact with angel investors. And angel investors are hard to reach because there are millions of deals chasing a very small number of accrediteds that are tired. They are beaten down by being bombarded with all these entrepreneurs that are out there trying to do deals. So the world of the non-accredited investor, which is the general public, is so much broader that that's really where the promise for all this to work is. So, going from the Reg D, you're really limited to a small network of people that you personally know. And I happen to have been lucky there because of my past, I've done enough deals that I know enough people that have had good outcomes that they're willing to say, okay, it's your thing, I'm willing to put some money in. So, that worked to kind of get us where we are. The next step after that's the 506C, which is that's the Title II crowdfunding, which allows you to basically take that same Reg D and now you can publicly advertise that to accredited investors. So that's a step forward, and it's beneficial, I think, for everybody. But at the end of the day, because that's available, there's now millions of deals that are chasing the same accrediteds the same way. So the same accredited investor base, the angels, are, again, they're bombarded. So it's one more place they get bombarded from. So I think now moving into Title IV, which is what we're talking about here, and ultimately Title III, which is the $1 million max raise, really lightweight regulatory environment. That's what's coming up. The final rules are supposed to be this month with implementation in 2 months, so by the end of the year. And that I think is going to be really interesting because for companies that only need $1 million or a little less, that's going to be a good way to go.
Just to really get the product even launched, because you launched your product. You have a product, right? It's fully functional. Right. But there are a lot of people with great ideas who don't have the product. So what do you do, Melinda? How do you select these platforms efficiently for what stage you are, right? Because there are all sorts of stages. Like you wouldn't go in front of Connie because you got to go through due diligence if you're just in a idea stage, right?
Right. Mm-hmm. So I think first you have to do some education in terms of within the Jobs Act if you're going to do a Title III, a Title IV raise. So I'll try to stay more towards the equity crowdfunding because in 2015, crowdfunding is a $40 billion business across donations, rewards, and equity. But I will focus on equity for the purposes of this conversation. So within the equity crowdfunding space, if you're going to do a Reg A plus deal, you have to look at the platforms that have the most experience. And so right now there really aren't that many. So it's really Start Engine, eventually Crowdfunder, and AngelList. Circle Up might be doing them. You also have to look at what type of company you have. So if you're a software company, software technology company, AngelList is great. If you're a consumer products company, Circle Up is great. If you're, Start Engine has they did the Elio deal, so they're kind of early in on the Reg A plus. So you have to make sure that when you're doing your research, not only did you pick the right platform to do the financial.
Once the world distributed this way, you can be in Walmarts, you can sell studio products, you can have Disney movies on it, you can sell in this channel, you can sell in that channel. But if you go directly to consumers today and they say, I love it, I want it, wouldn't all those channels open up as well?
In a heartbeat.
So that's
Absolutely.
a big issue, I think, behind crowdfunding, that it's not only circumventing the whole financial development of the company, but circumventing all the stakeholders in the old incumbent ways of inefficiently doing things, right?
Yep.
So that's part of I think that's part of the promise of this new way, right? Melinda, you wanted to say something about it?
Not anything, I mean,
that's the point, right?
Well, and that is the point, and then the truth is, and I've been a serial entrepreneur as well, and an angel investor, and when you are running a company, it takes 100% of your time to run a company, and it takes another 100% of your time to raise money. So that's actually, the last company I sold was in the natural product space, but Sand Hill Road didn't really understand that space until Jessica Alba got into the space, and now it's worth $1 billion and it's a unicorn, but I'm not Jessica Alba. So, I thought it was so important to have alternative ways for entrepreneurs to realize their dreams, create jobs, and so that's why I've gravitated towards crowdfunding. when you think about it, only 1% of the deals, if that, get funded by venture, and 99% of the time they're just saying no, 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 no. So it's a fundamental shift when you can democratize the way that entrepreneurs have access to capital, and that normal, everyday investors can get into the game along Tim Draper, along 500 startups, along all of these people, and so it's very fascinating to watch. I will say this because the audience is focused on new media, is that Indiegogo is going to make an announcement to go into equity crowdfunding. So that Indiegogo has done obviously very well within entertainment and digital media, so now you're going to see them go into equity crowdfunding.
And we love digital media. Belinda and I spent most of our careers in it, so we want digital media companies to get funding. And so does Connie now. So we have 3 people in the digital media, and John now is a new entrant into digital media space, understands our pain, because you funded companies in other spaces, advertising, FDA approvals, et cetera, et cetera. So interesting that digital media prompted him into Reg A plus. Any questions? Yeah, go ahead.
I was just wondering, has anybody thought about, to make any sense, to kind of have 2 paths, that when you're doing a campaign, that maybe you would do an equity and a donor side by side, and did both of those?
I'm just going to jump in. So I've been consulting on a project right now. I think the way that it works best strategically is to first do a rewards-based campaign, because you're proving to other financial institutions that there really is a need. So right now I'm working with a company called Giro, and so it's a luggage company, but less than a week ago we launched a Kickstarter campaign. We're up to about $800,000 now. Our next phase will be to move to an equity round where we'll raise millions of dollars. But it'll be much easier for us now to raise millions of dollars because we've proved through a rewards-based campaign that you can do it. So the way that I like to, and I've been advising them on their financing strategy, and it's working well, is that do the rewards first and then go equity next.
There's also some legal considerations around that. You cannot generally solicit, if you're going to do like the donations piece. You could put information out there from a marketing perspective that you think is right for your product that might bust your capability of generally soliciting for your actual equity raise. So you want to be very careful about those 2 steps. There are companies out there that are testing the waters. Elio right now is one of them. They've had about $40 million committed in terms of a reservation. They still haven't gotten through the SEC yet. And they have issues with the SEC because of what they've been putting in their reservation. So that's actually delaying their process. So you want to be very clear in what you're doing and have a very cognizant strategy around these things, because especially in the Reg A space, you have regulators that are participating.
And I'm going to jump in and answer your question too. So different perspective here. In our case, because we have studio content on our product, the studio content requires us, it creates a huge barrier to start selling the first piece, because there's upfronts and guarantees and there's commitments you have to make to the studios to get the content to put on the chip to sell to the consumer. So for us, we actually have this chicken and the egg problem where we need to raise the capital before we have the product to sell. So we could do a rewards-based campaign, and we've been thinking about whether does it make sense to be on Kickstarter and simultaneously be selling our Reg A+. Still not sure about that. So some of the people we've consulted with have said, hey, you need to focus on an integrated marketing campaign for your Reg A+, put all of your energy into that, do that really well, raise the capital, and then use Indiegogo and Kickstarter as marketing channels to essentially just sell our product downstream. Not sure if that's the decision we're going to go with yet or not, but that's the advice we've been given so far.
So it depends on what the product is.
Right.
Any more questions? Okay, so let's think through, let's say I have a company A here in the audience, and I have a product, and some people are interested in it, but I'm not making enough revenue from product sales to say that this is really a proof of concept, right, yet. But the product's ready, so I'm not in a prototype stage, I'm not, sort of with an idea and a plan. The whole thing is up and running, but not enough people have purchased it yet. what would each of you advise them to do? Let's see how unified this is now. I'll start with John because he's been in it. What would you do?
Well, I think given where things are right now, I'd wait for the final rules on the Title III crowdfunding.
The under $1 million?
Yeah, because I think that's going to be lightweight. I think that's going to be a quick and easy way to raise money. And I think you want to talk about putting pressure on angel networks. I think that is going to do it because it's going to be, at least what I've read so far, it looks like this going to be very lightweight, very simple to raise up to $1 million.
And that should be when, David? When is John? When's it coming out?
The regulation's supposed
By
to
the end of the year.
By the end of the year.
Yeah.
Okay, so David, what would you do?
Well, I think that you have to ask the question, if you're selling, are you a B2B or a B2C?
B2C for sure.
Okay.
Because
Because if you're a B2C and you're having issues, I think generally you want to then try and figure out some other ways because you will have just as hard of a time raising through crowdfunding if you don't have that traction. If you're a B2B, if you're something else where you have the capability of saying I have a really good technology, but we don't have the revenues yet because the market hasn't caught up, then you have a story to tell. Then you have something where you can actually say that this is going to happen in 6 months, 12 months, a year, and you can actually raise money on that today.
I'll give you a little more. I'm an augmented reality company in B2C space.
Okay, absolutely. Well, Magic Leap raised $500 million off of Google, and no one knows.
Trick question.
It's absolutely capable.
You should go to the consumers now.
Well, yeah, if you have the capability of showing someone something amazing, even though they can't buy it yet, then...
So it depends what market you're in,
Yeah,
because
exactly.
you're in a really hot area.
Yeah, exactly.
You may not need to prove that people are buying, headsets that may not work quite yet, but, right? Okay, interesting. Melinda?
I think John brings up a good point just because Title III will have such a profound impact on the crowdfunding space because right now the accredited base is 8 million. It'll open up to well over 300 million if that passes. So in the B2C space within virtual reality, the one thing is Oculus did a Kickstarter campaign and then sold to Facebook for like $2 billion, and then the original investors are stuck with goggles, and not with equity. So I think that actually is the best example to prove why, if you're an investor and a believer, get equity. Go after the companies that you're not going to get goggles, but you're going to get shares if you really believe in it.
That's a very good, compelling point for investment. Connie?
So the other side's Tesla.
Right. Can't get one.
Well, I think with the specific industry that you were talking about, I think you really need to research and find out which angel networks in the angel world are investing in that and find an angel to champion it for you. I know some of the most successful angel investors have been ones who think out of the box and don't just invest in the industry they know or the expertise that they have. They kind of follow what they think is going to happen. I think crowdfunding has really made that easier for angel investors who typically invested only in their knowledge or what they had expertise in. Now they can actually follow the crowd like the crowd does. And I'm really excited in all of the things that are happening, and the fact that Mariana is exposing me to so much of this.
And very quickly, thanks
good.
to John.
Yeah.
So
And
Dave,
one of the things I'd like to also add, with Keiretsu Forum, we've kind of raised the bar with Keiretsu Forum. We're kind of filling a different gap than most of the angel networks do. Our largest investment was over $12 million into one company. So as these companies go through these different forms of crowdfunding, then we can follow on after they've raised their million or follow
Did
on
we
with that.
practice this? Because that was my next question. So we basically have provided a platform for angels to move up
Right,
in the
right.
funding cycle and not
Right.
always be before the VCs, because we may not take the VC money, right, based on what John
Hopefully
said earlier,
not.
right? And then, David, you said there's a need for liquidity in these Series A. Why is there a need for liquidity of Series A investors?
So the main reason why crowdfunding hasn't been in place for ages, and it's because there is no liquidity. You have to be an accredited investor. The SEC and our government has deemed it very risky these are very risky investments. When you buy into a private placement, you're locking up your money for 5 years, maybe 10 years in a company, waiting for a liquidity event. For crowdfunding for Reg A to work properly, you're going to need to have a secondary market where anybody off the street, your grandmother, your aunt, can sell those shares if they need to. And if they can't do that and grandma loses her life savings or loses a lot of money, this entire new capital formation that we're talking about is going to go poof very quickly. So we're ahead of the game here in saying that we are building this platform for that trading capability. So your wife is getting a surgery or something like that, and you need that $10,000 back. You know, if you went to your broker because you bought it through the 506, which was this open solicitation but accredited investor thing, that might take weeks or months today to get that sold. Whereas in a secondary market, that can happen within hours, and that money will be back in your bank account.
That
Also,
makes it much more attractive.
I think it also drives more investors if investors know, hey, it's going to be easier to get my money out, even if you had to lose a little bit, but you can liquidate it.
Yeah.
Much more likely to invest.
Yeah, because it's not sort of like just your kind of hope for the best high risk capital that you can only allocate X many % of your capital towards. You want to say something?
No.
Okay. All right. So, no, it's just,
you covered that well.
this is moving like the speed of light. Yeah. Let's take another question.
Yeah. Do you perceive that it would be possible to do a combined rewards and equity funding program, so people both get rewards and?
Is that what Kickstarter is trying to do?
I have an answer to that question, but I'm not sure it's right, because I've asked that same question, and this is all new. So, you know, one of the challenges, we are the first company through the SEC process. So, you know, we actually were the first ones into the state coordinated review process and learned what a mess that is and why the tier 1 part of this isn't going to work. But so I've had that same question about, can you do a combined campaign? And I even thought about, you know, it makes sense that, you know, Kickstarter's rewards based. What if one of the rewards could be shares in the company? That seems like a no-brainer, right? I mean, you're going to put a $100 pledge in there. Why not, you know, a couple shares of stock as part of that too? And by the same token, if you have people that are buying your shares, can you, if you make a $1,000 investment, throw your product in? Well, we would like to do that because we want to seed the market with our product. So we'd like to do that too. We know we can do that, but we don't know about the other way around. From what I've heard so far, Kickstarter has said that they are not going to themselves have equity as a reward possibility. And I don't know about Indiegogo. Do you, Melinda?
I don't want to speak on that. I'll say this. I'll say this very cautiously, and I do not work for Indiegogo, but it is definitely my understanding that Indiegogo will move into the equity crowdfunding space. In terms of them combining it, I'm not certain because there's legal issues. Actually, Dave would be able to answer that, but I'm going to extend an invite to this, is that one of the heads of Indiegogo is going to, through Next Generation Crowdfunding, I'm holding a conference on November 19th at the Lowe's, and I'm going to give you guys a free pass. So it's on the 19th.
Thanks for
and
coming.
So it's the CEO of Seed Invest, it's the CEO of Indiegogo, John is speaking, I'm speaking. It's really an incredible lineup if you want to learn more. So it's on Eventbrite, and it's called Next Gen Crowdfunding, and a free code is VIP10. So come, and then you can hear directly from Indiegogo.
To the point, there is a legal issue with that. By giving stock away, you're starting to then get a lot of shareholders. All of these regulatory requirements have limits on number of shareholders, because then you start classifying as fully reporting public companies, et cetera. So if you have 1,000 people that you're rewarding with shares, you've increased your shareholder list. And you just have to talk to your own attorneys about what you can and can't do around that.
So there's like there's a numbers requirement of shareholders for different tiers that you may or may not be hitting and tracking on these platforms.
Right, and if you do that, and if you do cross a line, then all the work that you were doing under your Tier 2 Reg A+, which is up to a $50 million raise, might now force you to do a formal S1, which is a formal IPO. And so you just have to be very mindful of all that.
So, John, when you have to, let's say going through this process now, you have to sort of do marketing and figure out how the marketing's going to work, and then out the operationally, and from the just technology integration perspective, you have to integrate with a bunch of platforms to sell shares, right? So, let's talk about that just for a minute. How does that work?
Well, the platform integration piece is actually really simple. There's small snippets of code you can put on your own website to create links to companies that do the compliance work like Fund America. It's very simple to integrate that. It's also very simple to take your existing business plan and put it on a platform like Crowdfunder or EquityNet. So I don't think there's a lot of technical work involved in that.
But you have to have a BD relationship and all that kind of stuff to process the shares, right? Dave's been
You do have to have a BD relationship if you are a Tier 2 Reg A.
And so you have to integrate with the BDs.
Right. So you could self-sell. Like John can actually use the Fund America button and put it on his own website. Fund America will provide him with the wire service capability, which makes him compliant. But at the same time, you can also use a formal broker, a formal banker to do this for you. Who will
So
then,
either.
Yeah.
And what would the
The
broker
only
bring
thing
you?
the only thing I'm going to say about that, just from a UI perspective, is that once you move somebody to a different platform, you get like a big drop off. If it's not instant and quick and fully integrated, the drop off is just so high.
Like if someone's processing it on their side.
Yeah, I mean, even Crowdfunder processes through eShares, and we have to
Right.
move that because the drop off is so high, because you have to then sign up with eShares, go through their entire process, get accredited.
Which was
It's-
their BD. That was, yeah.
Yeah, so, well, it's actually how they were issuing shares.
Sure.
So it's complicated. Right.
And this is all being worked on right now, so a lot of these issues of cross-platformization and stuff like that is all being centralized. So if you have your own website and you have a bunch of people that are coming to your website, we can actually offer you the same capability. So you can put it, if you have 1 million people coming to your digital media website, you can have people think that they're still on your website. And we can do all the compliance on the back end and handle everything that way too.
So you would be like a white
I
label.
would pay attention to that.
White label, right? That's kind of the easiest way to process it. Okay. Yes.
John, can you talk more about your screening process? Can you give some tips about your screening process? I believe with
Kariatsu?
yes. And Connie, can you please talk about the exit strategy and what you expect in companies for the exit strategy?
Okay.
To qualify for the angel network? To qualify for their angel network?
Well,
or
she
for,
mentioned that when you go through a process,
Yeah.
there's an exit strategy, so I just want to know more about
Of course. You want to start?
Yeah, so I think our exit strategy is we have a consumer product. We think we're going to be successful with it. Our exit strategy is either we're going to become a public company and someone else will run it because I don't want to do that, or it'll be acquired by one of many companies we've identified that could be interested in owning our business. So in terms of the screening process, I think that what Connie was talking about is just the fact that the work that you have to do to apply for, to get through the SEC process on what's called a Form 1A, the amount of work that you have to go through with the SEC is substantial enough that the federal government has actually already vetted deals that have gone through that process, so that now other investors can look at it and say, well, first of all, there's an offering circular they can look at that has all that information in it. So the amount of work that has to be done for screening a potential company in the case of an angel network is pretty much already done. They just have to look at it.
And tell her the components. It's like a business plan in a form
Yeah,
of a private offering memorandum, right?
Yeah, it's ours ended up being, I'm going to say, 40 pages, and we had 5 revisions of that with the SEC before we finally got to what's called a no comments letter, which means you can now formally request qualification. And we were on what's called a Tier 1, which is the $20 million cap version of Title IV crowdfunding. And that's the one where it requires the state process. So we got there, first company to do that, and then we went to the state coordinated review process and found out very quickly that that was a complete mess and that wasn't going to work. So now we are auditing our books, and we are going to amend our offering in the middle of November and submit it back to the SEC, who's already, they've already verbally told me that our offering the first time around was good enough that with audited financials we'll have a little bit more of the accounting review work to do with them, and then we'll have a qualification. So we should be, if all that holds true, we should be selling our shares around the middle of December. We may, for marketing reasons, because it's Christmas, decide to wait until second week in January.
And the underlying for that, the business plan that went into that, figuring out how are you going to sell your product, the revenue that you will generate, what kind of money will you need to get to the exit, which is a sale or a public offering. That's what Connie's group did. They call it a due diligence process before they put you in front of the forums, and she'll tell you a little bit more about that.
Well, we have two steps. The screening process is what we go through before we put them in front of the investors. And on our platform, we do have a platform that we use called Proceeder, and that's something that a lot of the angel networks use as well. And it is only for accredited investors. But what I was talking about was the due diligence process. Once a company has gone through the process and presented to our investors, then the due diligence begins. 9 times out of 10, companies don't have all their documentation in place. They don't have all of their agreements. And so it's very difficult for investors to do that due diligence, to work through that process. Usually it's a team of individuals. But because John has already gone through all that, he's got a book of work that all we have to do is bring the investors together to look at it and review it. And it's already passed the scrutiny of the SEC. So I think it's phenomenal.
It helps.
In moving forward with that. Typically, we're looking at anywhere from 4 to 6 year exits, and would be with an IPO or a merger or an acquisition from another company.
And it should sort of be clear to the entrepreneur, this is what I'm building, this is my path, right? And then, Melinda, you can probably give her some suggestions based on all of your experience of qualifying, because you're the crowdfunder platform, you had to qualify as well, right? And we went through that as well.
Sure. I think it's important to be investment ready before you approach a platform. So what that means is on the marketing side, you really have to figure out what you're going to do from the marketing side. Already have the video, already have the images, already have the testimonials. Ideally, you would have even a lead investor. And then on the legal side, you have to have either, what we were dealing with is convertible notes or a price round. And so all of those legal documents in order to be able to raise money needs to be complete before you can turn on a live campaign on Crowdfunder. And it is true with like average angel investing, it's 8 years before people sort of see an exit, because in the industry right now, there's more compound growth occurring in the equity crowdfunding space than there is in the traditional venture side of the business. But that being stated, there still hasn't been, and there won't necessarily be for several more years, a successful exit story coming off of equity crowdfunding. Maybe that'll change with Reg A and having more companies go through the pipeline and them being at a later stage. But to date, on the crowdfunding side, it's replaced and having a seismic effect on venture capital in the seed and Series A. But with Reg A Plus, that's going to move it to being able to raise $20 and $50 million, which is a completely different game.
So we may see some faster exits, and that may spur up some more investment.
Yeah, and Reg A can also be an exit itself.
Right.
You can sell up to $15 million of your own securities, or your personal if you're a founder, under Tier 2. So we're starting to see companies do that or consider that.
Fascinating. Any more questions from the audience? Okay. Let's say you've raised the Series A. And I've seen a lot of companies like this. You're not getting along great with your investors. And you don't think they see your vision. And they won't invest in B. And that's now very much damaging to you because you raised A, and the higher value, perceived value of that A investor that doesn't want to come into the B round, the worse the mark on the company. How is this market now opening up opportunities? These are companies that probably have revenue already and are, and have customers, et cetera, et cetera. So this is a later stage stuff. What happens to this market? How does it change this market fundamentally?
It's actually improved it significantly. The capability of now you being able to ask anybody. It's general solicitation, general investment. If you had a VC who is in, you can't control what that VC has done in his other investments. His fund might have crashed. That's why he's not participating in the next round. You know?
There's so many reasons.
There's so many reasons, and that now you're stuck because this one investor is 30% of your company, and they control a lot of your capability.
And they have preferred shares, for example, and you're like really stuck.
So you can now start going back to the public markets in a lot more forceful, meaningful way, where you can actually replace that person. You know, if you have traction in the market, you're able to raise that Series B or that Series C, or if you're going for $5 million or $20 million. The Reg A allows you to open solicit for an entire year once you have a qualified security. So you might only need $5 million of your 50 right now, but then you can use that open paper without having to go back to the trough, without having to go back to your investors, make a new PPM, do everything else like that. Just take that $5 million initially, and then 6, 8, 12 months down the line, go back again. And it's under that same security, under that same capability.
Yeah, and in terms of the venture capital investments, how is that actually going to change the way that VCs possibly invest? Because at the moment, there's this race to invest in a unicorn, and like a lot of the money gets tied up in Magic Leaps of the world, or in Ubers, or competitors in the shared economy space. How is that going to change?
Or Theranos, that just blew up last week.
Yeah,
Exactly.
So the public markets are a much more transparent market to be in. So you're not going to have a lot of these companies that are hiding.
Like Magic Leap not having a demo for how long now?
Yeah, they still don't have a demo.
Well, they have one as of yesterday, but it's yeah.
Is that a demo? It looks like
right,
a nice video.
Right, exactly.
It's a good website.
Right, exactly.
It's improved imagination.
Right. So, but that's just it. I mean, like, what are they now, to 97 unicorns, or how? I mean, which means the VCs have all gone and put money into the same deal.
The only thing that I want to say, which is a little, I mean, I feel like I'm going to throw up if I see another unicorn or hear of it. I mean, honestly, because it really is only relevant if there's an exit and the people that went in, so it's, I think the conversation should be how many unicorns have actually successfully exited, and what was the return on rate of the people that invested in, quote, these unicorns. Because when you look at it, the IPO market for the tech side is actually slowing, and within that, the IPOs that went out didn't do as well as they were supposed to do. So for me, I actually call bullshit on the unicorns.
I think this will actually push the market in that direction because of the transparency that David mentioned, and the fact that you're saying, Melinda, that a lot of that was sort of inflated investment.
The reason why
that's what I think it's inflated, and there's no exit. So until there's an exit, we really know what the
reason
public
why there
value
are
is.
unicorns is because the venture money, they're all afraid of taking risks. They're not risk takers. The name venture capital is a name that doesn't really make sense. That's not really what they do. They're really looking for low risk opportunities, and they filter through everything they possibly can, trying to find a winner. And unfortunately, their batting average isn't better than Hollywood studios is with making movies. It still is a one in quite a few. So the unicorn is by definition $1 billion value before it's really been valued by the real
market.
World.
Yeah.
So
There's no market value to them other than venture capital value based on their previous
based
round.
on them all.
Coming in together.
Yeah.
Which I think creates a great opportunity for Reg A Plus to take off as funding source, because not many deals can go in and say, yes, we're going to create a shared economy for driving your someone somewhere at some point in time, because there's not much more money available for that, right? So if you have a company that's breaking ground in digital media or technology or other of the verticals where VCs invest, you actually have a better opportunity to fund it.
Yeah, I mean, I think that's true. Connie was talking about this. When you look at the angel network, some people call it the PayPal mafia. So it's a very tight-knit, inside baseball, shared deals. And so those are the people that get in the early rounds of Facebook and Twitter and Uber and Washio and it's a very, very small list. So what I think is really exciting about crowdfunding and Reg A Plus is that it truly does democratize access to capital. And so I think the other thing that I want to say on that is I think it's also important that, and we have to pay attention to like the fraud that's going to occur, because I am concerned, and Dave, it'd be great for you to talk about that, but I'm concerned that people aren't going to disclose, everything that they should be disclosing to potential investors, and that fraud is going to become, a major issue within equity crowdfunding.
That's the single biggest concern of FINRA and the SEC is this, and that's why crowdfunding, this Title III isn't out yet. The states are scared of it. The government is scared of it. Of this fraud capability. That's why it's $1 million limit.
That's probably why we couldn't even get Tier 1 passed by the states, even though they're supposed to.
Yeah.
Right.
Yeah, well, I also think that, the transparent market has a good way of dealing with that. If you look at users of eBay, it's very hard to create another seller account if you screw up the first one. And because of that, the marketplace works. And I think that we're going to see, there's going to be bumps in the road, to be sure, but
Self-policing.
yeah, I think to some degree it's going to be self-policing, because people that are involved in deals that go south, they're done.
Yeah, and it happens in the bigger markets too. Valiant is getting raked right now. So I don't know if you're familiar in the pharmaceutical space, but there's a lot of Enron talk going on in these publicly traded big companies again. So that's something that is always going to be a risk in the market. The problem is they didn't want to open it up to unmitigated complete risk with the crowdfunding space.
And probably, global platforms, so there's global risk, and it becomes interesting proposition too. But to John's point, there's so many platforms out there that are already self-policing, so hopefully this will happen in Reg A. Any other questions before we let you go and relax? Yeah, go ahead, one back there. Let me have her first and then your second.
I just was asking Melinda if she could repeat the event that you were going to speak at.
Oh, yeah.
Oh, sure. So it can be found on Eventbrite is the site, and it's November 19th at the Lowe's in Santa Monica, so just down the road. And the name of the event is Next Gen Crowdfunding, and the code is VIP10. And it's an incredible lineup of, some of the biggest thought leaders in the entire equity crowdfunding space.
And then let me go back to my entrepreneur here. Go ahead. You. Tell me your name.
My name is Shay. So Reg A is crowdfunding and private equity together.
Yeah,
That's a good question.
Yeah, I could clarify this. So
Yes.
crowdfunding, there's 3 or 4 ways to think about it. The idea of general solicitation, people buying securities. The government has delineated what the different pieces can be. So this last piece of crowdfunding where you can generally solicit and it's very light regulation isn't legal yet. It's coming. There are crowdfunding sites available today. Crowdfunder is one of them, Start Engine, et cetera. They're working under a different title of the Jobs Act, which is accredited investors, where they can generally solicit, but it's a private placement for only those people. Reg A is now the open solicitation, open investment for everybody, but it is a lot more regulated. So you have to have, if you're going to go Tier 2, which is the way most of these companies are going, John has already articulated why, because of state law that he's going Tier 2. You have to have audited financials, you have to have quarterly reporting. So you're an IPO, but you're a light public company. So it's not as much reporting as you would have to do if you're a full reporting public company on NASDAQ. But you have to go through a regulatory process. You're going through accountants, lawyers, and everybody else like that. So if you're raising $25 million, it's a much more efficient cost of capital than trying to go through the VCs or someone else like that. But you have more regulatory issues that you have to worry about.
And that's different than what a lot of people call crowdfunding, the rewards-based crowdfunding like Indiegogo and Kickstarter. That has been called crowdfunding. In my opinion, that actually really isn't crowdfunding. That's pre-sales. So that's a different thing yet.
Well, it's just a different type of
Yeah.
Because actually the largest, I know this is weird, but just to be technical, on crowdfunding, the largest area of crowdfunding right now is donations. So it's actually GoFundMe. So it's the largest portion of crowdfunding is donations, not rewards, but donations based. So when people are sick or when this or that or something's happening, it's GoFundMe is the largest crowdfunding site in the U.S.
Yes.
I understand that equity funding will be online, but for very cutting-edge technology companies, that would be a major issue because there is no way to know that far ahead of time what will be the value of the company or this line of business. There's a lot of technology companies, they start for something, and in 6 months they discover there's some little feature in there that actually the market wants. And they totally pivot and go in a different direction, develop something else entirely.
You mean like Apple?
That's a lot of companies, like Facebook, like Snapchat, like you name it, every company. Lots of companies in this business. And the issue is that when you go for equity funding, essentially you put a value on that company way ahead of time, and you might be short selling the
Yeah,
business.
that's a good point. Yeah, that's a good
Yeah.
point. Yeah.
But you really-
It's true in the public markets, though, too. I mean,
Yeah.
look at Netflix has got a 500 PE or something like that, and Tesla's 250, and, you know, Apple is 9 or 10. I mean, these don't make any sense, right?
Yeah.
So they're...
It's the same thing. It's investment banking. It's an art, and it's not a science. So it depends on your industry. It depends on what you're talking about and what the capability is. So, like, what we try and do if you're a technology company that is trying to get a third party to give you a value. Because if I'm doing the deal with you, I'm going to say you're a really low value. And someone you're going to say you're really high value, but we need a target to get to. So that's, and the technology is going to change. We can only work from today. So 6 months down the line, if something changes, and you're going to be valued on that.
And go ahead.
Connie made a comment earlier about angel lists and angel investors who are kind of industry specific. So if you use your crowdfunding on a Kickstarter or Indiegogo pretty much to substitute in for your friends and family round so that you have a proof of concept, how do you know, is there a public way to find out who the angel investors are that are industry oriented?
Yes, it's online. You can look up almost any angel network, and it's all listed within their sites. Most of them.
And then
Ours
there's
is
Angel
very.
List.
Caritzi Forum is very diverse. We invest in all types of opportunities. And another thing about the angel networks, I think, and I'm really eager to see to it that we integrate better into the crowdfunding, is the resources that you get from the individuals who actually participate, not just the funding, but also the resources, the connections. A lot of that doesn't happen with online unless there is a connection. And more of a connection than just an online platform of investors investing dollars. The resources are invaluable.
This is interesting that you bring that up. I was a Section 16 officer of a public company in one of my jobs, and what that basically means is you're sort of responsible for the value of the shares, together with the CEO and CFO. There's usually 1 or 2 Section 16 officers. And so my phone would not stop ringing. We were publicly traded, and we've been publicly traded at that point for 25 years, so, been around. And my phone was ringing off the hook day in and day out with people, because I was heading up biz dev, digital biz dev, and people would call me and say, I have a suggestion for you on how you should sell to Target, And then some other investor would call me and say, I have a suggestion for you on how you should do your electronic games. We have 20 different product lines. They were calling me with contacts to, people they know that they think would get us to do a better job of adding value to their shares. So there will be I believe, there will be no dearth of suggestions from your public once you take their money as to how to do your business better. So what Connie's saying, though, you're going to get some experienced angels to come in who have had sort of a proven track record. So when you're taking that phone call and someone's saying, oh, I know how you should sell to Target, you actually know if they actually sold to Target before or not. So, but you will get that. That's interesting you said, because now I'm flashing back to never being able to pick up my phone at work. A couple of years, I was like, okay, thank you for that. Yeah, so you will get, once people start investing in you, they will have ideas of how your business should be run.
And a lot of times they invest because they feel like they can help you.
Right.
They know that they can make a difference in your company. They know what they can do. They know the connections that they can make and the value that it will bring to you. So it increases the opportunity for them to have a better return.
True. And you'd want those. You want that help. So being in an angel network, you know, they sort of successfully invested or exited before, so they may be able to help you a little more. You know, there's a bit of a community there.
The list of people that Melinda mentioned earlier, if they invest in your company, just the fact they invested in your company.
Oh, that's
changes the value of
true.
your company.
That's true,
yeah,
too.
that's true.
Very
too.
good point. Yeah.
Yeah, well, and another thing that's kind of interesting is you're seeing more of this hybrid model between equity crowdfunding and having a fund. So Paige Craig is one of the angel investors in AngelList, but he's a big syndicate on AngelList. He's just raised $37 million for Arena Ventures. So he has a fund. So anytime his fund now invests, he uses equity crowdfunding to fill the round, which is like a really fascinating hybrid model. Circle Up's doing the same thing. Crowdfunders working on doing that. So you actually have a bunch of these sort of angel investor networks also sitting on a fund. So it's an interesting hybrid model between venture kind of and equity crowdfunding.
Great questions. Any more? We're on one more. Okay. Oh, we had one in the back. Do you want to ask yours? Yes, you. Sorry.
I was curious how reggae could be applied to, say, a new company that is focused on media and diversity.
Media, define the business model.
Film, television, an area that essentially provide content for film, TV, but is a diverse company also looking at a worldwide market?
Is it a multi-channel network, or is it more of like a studio?
It would be more of a
Production.
that would grow potentially into a studio.
So Connie's looking to take her investors into the realm of production companies in Hollywood, but in general, you know, the venture markets have not supported content production. Even if it's, you know, sometimes there was some portfolio of investments, like when I was at Sony Pictures, we invested in the Silver Screen Partners. And the problem with the Silver Screen Partners was that in the first year they had some good movies in it. In the second year they were cherry picked out. Third year got worse and worse. And this is, you know, just top studio products. So after that, there's been a reluctant investment by private equity and venture capital. I've never really seen that many, even in the first stages of it, and we raised a lot of it for digital media networks, just into production. But if you're aggregating and distributing and you become a multi-channel network, that becomes more appealing. You know, and clearly the content's great. It's consciously created versus, you know, what we see on TV and film. There's a need for it, et cetera, globally. It's quality, you know, I don't have to tell you, I'm the biggest fan of Empire myself. You know, it's the right time. But the idea is going to be, how do you create a company that you can fund? Is that what you're going to say?
Yeah, so I think your question was, how does Reg A affect that? And you probably know that it's hard otherwise. So I actually think that if you can connect with the audience can fund what you're doing. And I actually think there will be a big connection there for that reason. Because it's very hard to find investors to invest in anything right now, because there are not many of them, and they're being bombarded with deals. And plus, it's just cumbersome to make the connections. But when you can publicly solicit, then the world can find things that they're interested in and go straight to you.
So you have a better shot, yeah.
And Reg A allows you to test the waters. So you can actually go out before you've spent hundreds of thousands on attorneys and brokers and everything that goes into one of these processes. Test the waters and actually say, oh yes, I do have 100,000 people that are going to sign up and buy shares of my media company.
And that's
So
brilliant.
that
You can
leads
show
me
me.
to a question for you.
Yeah.
So Okay.
My question is, to test the waters, do you have to have an active filing at the SEC?
No, you don't.
Okay, so pre-filing, you can do test the waters.
Yes, you can.
So maybe that's the best way for what you're thinking right now without going to MCN, just as we come up with it here today. It's probably to test the waters because the quality of the programming or your stories will drive, and passion behind it will drive probably investment from public. And you'll see if it does, right? Yeah, I've struggled for years trying to figure out how to create content that will drive digital media platforms. Very hard, right?
What John has done, I've been saying for years. So you take the case of Barry Gordy. Barry Gordy's family had an investment group within the family. So they could pitch an idea in the family, and the family put in money in a pocket every week or whatever for the jobs that they had. So in his case, he pitched an idea of a record company, and they gave him $500. Well, the rest is history. So, but the idea that you have, John, which is there are underserved markets essentially, if you can tap into where they are and who they are on some kind of platform and communicate with them, then they can get back to you, and then you can grow that community of potential buyers and investors.
Right. And
Yeah.
they're your customer. That's why it works, because they're your customer too.
Exactly. And they're vested, like you say, they're vested, so
Right.
they're going to market it for you, and they're also going to participate and buy more and sell. Because
Yeah, they're going to sell for you. That's right.
Yeah, it is actually an ideal opportunity, probably. Do you guys have anybody else has any pointers for him? Yeah, great questions. Last one.
Do you feel that this will be too cumbersome to on a single movie basis?
But that's what I was saying earlier. Investing in content is just, I think it's hard.
Well, I know that it's hard at the moment, of course, because there is a limited number of investors and they're all being bombarded and they probably have their fingers burnt anyway. But when this opens up to the general public, in a regulatory way, I'm asking.
Yeah, from a regulatory perspective, there's no reason not. If you have IP or something like, what was it? There's 2 or 3 that have gone through Kickstarter or Indiegogo that have funded actual movies from a rewards-based perspective, individual films. So you can do that. You could also say, I want to raise $25 million for whatever movie it is, or $50 million or for whatever movie it is, and go that direction. There's nothing within the regulation that says you can't do that.
So it's going to be very interesting to find out what actually does happen, because
Right.
I'm sure there's going to be movie makers that are going to want to do exactly that. I bet that'll happen.
Of course, because there's no other really good way to fund
Right.
films, right? It's obvious, other than passion investments at the moment. So, and those have to be searched. So great questions. We hope that this panel will help you fund many of your media, entertainment, digital media projects and companies, and we'll continue to grow this marketplace. Just before we leave, what do you think is the most important thing from this whole Reg A opportunity that you see that maybe you can share with the audience?
I've already said it. I think it's connecting for companies that are selling to consumers. It's connecting with your consumer base. You're getting a twofer. That's a good way to put it, because you're educating the consumer about your product, and you're collecting capital from them to help you do more of the same.
And then David?
It's faster access to capital. I think that we're too stringent on our regulations previously, and now we've basically turned off the taps for the earlier stage companies to get capital. Now we've opened them again. So that's what's coming with Reg A.
Melinda?
Yeah, I think it's faster access to significant capital, because we're talking about being able to raise $50 million over a 12-month period, which is very significant and can have a seismic impact on venture and the hedge funds and things like that. And being, as John said, being able to connect to the crowd, to people that are going to support the dreams and the product that you're believing in, it's pretty phenomenal.
Connie?
And I agree with the other panelists, and I think the biggest thing for us is proof of concept. But I would like to leave everyone with the advice: educate yourself. Educate yourself on what's out there. Find experts in the field. Don't make the mistakes that I see a lot of people making
In
even
startups,
today
yeah.
in startups. I know we had 3 companies that wanted to come through the forum. They went on crowdfunding and they flopped because they didn't really know what they were doing. They signed up with the wrong people who really didn't have the experience with success. So educate yourselves and connect with the right people.
Get the A team.
Make it happen.
Like we have today. I think you shifted my perspective, I think, during the panel, that this is really possible now for individual film, television, and other media projects, and I would say portfolio of products to possibly be funded by the audience that believes in it. So I think that's the most important thing I've learned today. I want to thank our panelists and thank the audience for staying with us this last day, and thank you for sharing.
Thank you.